one thing that I found very interesting is the trend of bullion banks versus non-bullion banks. So the bullion banks being JP and Citi and Bank of America and Goldman. These are the commercial banks that are the major traders in bullion. 17.5 million ounces of silver was transferred from bullion banks to non-bullion banks here just a few days ago, making it one of the largest transfers in Comex history, but going to sovereign wealth funds, family offices. This could be a proxy for the PBOC. It could be a proxy for Saudi Arabia. We don't know who they are. A proxy for India, a proxy bank, or a proxy sovereign wealth fund, or a big family office that's set up here in North America and standing for delivery over the Globex.
For years, gold and silver analysts have argued that the forces behind the manipulation and suppression of the precious metals market are gradually losing their powers, leaving both precious metals to gradually begin to assume their true values. The analysts argued that these forces, particularly the so-called bullion banks and exchanges like Comex and the LBMA, are getting pelted with requests for deliveries, which are completely antithetical to the system that has helped them suppress and manipulate precious metals prices for decades. While these arguments may have seemed like mere speculations in previous years, several developments this year have helped expose the issue and lend credibility to these arguments. One of the most obvious developments is what many analysts are describing as the LBMA default. In recent weeks, the London Bullion Market Association, LBMA, has encountered significant challenges in fulfilling physical gold deliveries. Traditionally, the LBMA promises delivery within 2 to 3 days. However, delays have now extended to 4 to 8 weeks. This disruption stems from a substantial outflow of gold to U.S. Comex warehouses, with 12.2 million ounces shipped over 2 months amid speculation about potential U.S. import tariffs. While LBMA data showed 279 million ounces stored in London vaults as of December 2024, only 36 million ounces were theoretically available for immediate market use, revealing a critical liquidity shortfall against an estimated 380 million ounces of outstanding spot or cash contracts. In a recent interview with Liberty and Finance, renowned bullion dealer and president of Miles Franklin Precious Metals, Andy Schectman, exposes some more incredible developments, particularly the recent flow of 17.5 million ounces of silver transferred from bullion banks to non-bullion banks, one of the largest of such transfers in Comex history. We will bring you clips from Andy's insightful interview as he attempts to break down these new trends and what they mean for gold and silver prices in 2025 and beyond. Please watch to the end, share and like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for the support and enjoy the video.
Yeah, resilience is a good word, Dunnigan, and it's showing great resilience. Most of us have been conditioned to expecting the floor to drop out once it corrects, like we saw a few days ago, and here we are right back pretty darn close to where we were before the correction. Today, gold is at, where are we at today? Let me just double check here. Oh, we got gold up $22 right now to $29.20. Silver up just a little bit, just a tick or two at $31.82. Climbing back to where it was. The resilience is a very good word, but really what to me is very different, again, as we've been talking about now for the better part of a month, is that traders on Comex are no longer rolling over their contracts. Many of them aren't, and that's really the difference. That's what enables this rehypothecated system to continue, because we don't stand for delivery, so we just keep rolling it over. It's a cash settlement, it's a speculation, or it's a hedge, but standing for delivery was something that never happened. And we started talking about this in 2020. I guess I'd rather be 5 years early than, 5 seconds late. And we were talking about how there was a slow bleed down of inventory and deliveries happening at an accelerated pace, which was really unusual at that point, like an outlier. Well, not so much anymore. In fact, contracts standing for delivery have led to an open interest surge of over 750%. Open interest meaning those that are standing for delivery. I guess to me, this raises the question, why are the traders and the nation states and the central banks suddenly standing for delivery? that should be something people are asking themselves. The folks that are standing for delivery are not something to be dismissed. These are very sophisticated traders. And at the same time, another strange occurrence is that the net long position on Comex is rising rapidly, while the short position is at its lowest since 2020. So being naked short right now when everyone is standing for delivery is akin to a mud wall in a rainstorm. Stupid, to say the least. We talked a lot about the contracts that stood for delivery last month. 15,691 contracts stood for delivery, 78.5 million ounces, second highest in Comex history. Another 4.6 million ounces of silver was taken for delivery on Friday, this last Friday, bringing the 20-day total to 41.2 million ounces. That's 4 times higher, at least, than any previous year in silver. Comex delivered 50 million ounces of silver on the first day of March deliveries. But where is the media talking about any of this? Do you hear them? I don't. You and I do, and folks on your channel do. This is monumental. This is the same kind of environment where, why didn't the media tell us gold was reclassified as tier 1? The important things they're not telling us. Since December 2024, over 600 tons or over 20 million ounces have been moved into the vaults in New York City. This is an anomaly for sure. I find it interesting. We've seen 28 million ounces shipped from London since mid-December, yet now they say it's a T+8 week exchange instead of T+1 day, as it's supposed to be. And the question would be, if they were able to send 28 million ounces of gold since December of 2024, why all of a sudden are there delays of manpower and of trucks? It speaks more to me of a default.
According to recent analysis by Michael Lynch, a popular commentator in the gold and silver sector, 6,183 contracts closed on the March silver contract's last day before first notice on Comex. While this is typical of last day's closings, it is almost unprecedented for the numbers to stay that high just after a price plunge, as price plunges often significantly impact contracts closing on the last day. In his analysis, Lynch surmises that the resilience of longs standing for delivery could be signaling the presence of a new type of buyer who is less impacted by price plunges. This could mean a sovereign wealth fund, central banks like the PBOC, and other powerful buyers looking to gobble up what's left of the exchange's inventories before they dry up. Lynch also points out that a near-record 15,691 contracts, or 78.5 million ounces of silver, stood for delivery in February, the second largest in Comex history, topped only by 16,834 contracts that stood for delivery in July 2020. These deliveries are mostly from bullion banks to non-bullion banks. JP Morgan alone issued 5,590 delivery notices, amounting to 27.95 million ounces, a tie with their prior record set in July 2020. While all this is ongoing, the stock and crypto markets are getting absolutely hammered. Andy suggests that when the situation becomes more glaring, millions of investors will swoop into the gold and silver market for protection and safety. Here are more clips from his interview.
One thing that I found very interesting is the trend of bullion banks versus non-bullion banks. So the bullion banks being JP and Citi and Bank of America and Goldman. These are the commercial banks that are the major traders in bullion. 17.5 million ounces of silver was transferred from bullion banks to non-bullion banks here just a few days ago, making it one of the largest transfers in Comex history, but going to sovereign wealth funds, family offices. This could be a proxy for the PBOC. It could be a proxy for Saudi Arabia. We don't know who they are. Proxy for India, a proxy bank, or a proxy sovereign wealth fund, or a big family office that's set up here in North America and standing for delivery over the Globex. These are very unusual things, and people should be paying very close attention that these kind of players don't take 17.5 million ounces of silver just for the hell of it. This is way outside the norm. We've seen the same thing in gold with February contract. Same thing, massive delivery from bullion banks to non-bullion banks. Well, who are they? They're the others. That group, the others we talked about, not really sure who they are, but we know that they're not bullion banks, but they're wealthy and sophisticated as hell. And that lends to conspiracy. Who could it be? Big money, to say the least. I would argue that, some people would say it's Fed proxy bullion banks are probably the biggest buyers. So, even the banks on behalf of the Federal Reserve, and they say proxy so that they're set up in a different way. A family office, a sovereign wealth fund, as I mentioned, some sort of a fund, a hedge fund, doing it on behalf of the Fed, could they? Or maybe on behalf of other entities. China, CTA, commodity trading advisors, are following suit. This is continuing to happen. Now, let's talk about, at the same time, what's happening in the marketplace. Kind of caught my attention, and of course, I'll take any questions. These are just things that have caught my attention. The VIX on the stock exchange has moved up, surged above 20 for the 6th straight day. Since February 14th, the VIX is now up 45%. So you're seeing great volatility, not only in the crypto market, but also in the S&P. I find it interesting that hedge fund exposure to the Mag 7 is at a 22-month low. So all of these people that have been driven into the Trump trade, the risk-on trade, the AI trade, the hedge funds, again, the big money, it's at a 22-month low. We've talked about the insider selling, NVIDIA shares selling, Jamie Dimon selling, Bezos selling, Zuckerberg selling, 7-to-1 insider selling versus buying the hedge funds at a 2-year low. And yet all of this money that has ridden this up, what does that tell you for where it could potentially go when the big guys are leaving? And institutional capital is moving from risk on to risk off all of a sudden into gold, out of Bitcoin. Bitcoin, it's interesting. It's almost like a retail trap. They announced the crypto fund, and crypto's gotten killed since the last 2 days since that came out. It's like the old adage, buy the rumor, sell the news. I found it interesting that the Atlanta Fed has revised downward their GDP expectations to negative 2.8%. from 4% a month ago. Trump's going to get blamed for this, but they're saying growth is now going to be negative by almost 3% instead of positive 4%. That's not good. So these are the things that I think, at least from a standpoint of what I see happening, biggest money in the world is standing for delivery and rushing to get gold. London doesn't want to let go of the gold because it's massively rehypothecated. And the markets are massively overvalued. At the same time, every single metric that speaks of recession is screaming, we're here, the uninversion of the yield curve, the record amount of money in money markets, the unemployment numbers going higher, the Claudia Sahm rule, all of these things have been triggered, and yet...
Over the past week, gold prices experienced notable fluctuations influenced by trade tensions, economic data, and shifts in investor sentiment. On March 1st, 2025, gold was priced at approximately $2,857.93 per ounce. By March 3rd, prices had increased to around $2,898.25 per ounce, driven by escalating trade tensions following the implementation of U.S. tariffs on imports from Canada, Mexico, and China. The following day, March 4th, gold experienced a slight decrease to $2,892 per ounce, as investors cautiously assessed the impact of the new tariffs. On March 5th, gold prices remained stable around $2,913.79 per ounce, as markets awaited the release of the U.S. non-farm payrolls report, a key indicator of economic health. By March 6th, prices edged higher to $2,921.19 per ounce, supported by a weakening U.S. dollar and growing anticipation that upcoming economic data might influence the Federal Reserve's monetary policy stance. Several factors contributed to these price movements. The U.S. decision to impose a 25% tariff on imports from Canada and Mexico, alongside increased tariffs on Chinese goods, heightened fears of a global trade war, prompting investors to turn to gold as a safe haven asset. Additionally, the U.S. dollar fluctuated in response to these trade developments, with its weakness making gold more attractive to investors holding other currencies. Market participants were also closely monitoring economic indicators such as the ADP employment report and upcoming non-farm payrolls data to gauge potential shifts in Federal Reserve policy. Moreover, increased gold purchases by central banks, particularly in China and India, provided further support to prices. Looking ahead, analysts suggest that if trade tensions persist and economic data points to a slowdown, gold prices could continue their upward trajectory, potentially testing new highs in the coming months. Do you agree that gold and silver prices are poised for new highs in 2025, especially considering the recent waves of movements from exchanges and bullion banks? Please share your thoughts, comments, and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and check out our other videos to keep abreast of developments in the precious metals industry and overall global economy. Thanks for watching our videos.